Hi, friends. Hope you guys doing really well. Thank you so much for joining me today, friends. Very quickly, I want to cover some very interesting things about investing today, which I'm seeing all around me, friends. Even right now, when we are recovering from the war effect, I'm seeing so many people not investing into the market and still playing the waiting game, friends. The biggest problem with stock market investing is trying to time the market. While you can approximately try to time the market, but is it really possible to time the market to the t? And that's what most people are trying to do, and that is the reason why they're not able to build confidence ever, because they don't believe in probabilities, they believe in certainties, and certainty in life or in markets does not exist. The most important thing in investing is to act. We all keep predicting what will happen, that will happen, this will happen, what will Trump do, how will the war shape up, but we forget the most important thing. This entire scenario which is going on currently has to end sometime or the other. And why can't we just keep buying installments? As the stock markets keep going down, we keep buying, and if it does not go down, it goes up. It's all the more better for us. We will upward average. So what is the main problem with investing, and what is the right strategy for you? The right strategy for you will depend on how you are. The most important thing to consider is what kind of investing you want to be comfortable with. The Do you want to do an investing which is based on simple RSI being more than 50, 60, and the stocks which are breaking out? You want to get into those without any fundamental analysis? Do you want to get into stocks which are in which are have the highest growth pattern, which are growing the fastest in the country? Do you want to get into stocks with the best return on capital employed, with the best pedigree currently available in the country? What do you want to do? So, friends, every strategy works. The problem is that we are not able to implement our back tested strategy or proven strategy to the T. So, when I say every strategy works, I really mean it. It obviously needs to be back tested, but it will work if you execute it to perfection. Now, execution to perfection requires the right behavior. Let me let me assure you that the right behavior is not easy to come. So, friends, there are three stages to execution and learning. First, there is a stage where you call learning, which is basically the stage which is today. Like, you are watching me today live, and you're coming to know about certain things about investing, and this is called the knowing stage. After that, after the knowing stage, there will be a doing stage, which requires execution, which requires you to implement the strategy to the T. But to implement a strategy to the T, you need the right behavior, because without the right behavior, you will not be able to implement the right strategy. But your work does not end here. Once you come to know of the strategy, once you start executing the strategy, the main thing, the key, is to start executing it over and over again. You need a repeatable system to be successful. What's a repeatable system? Let's say, where is your stop loss? Where should you cut your losses? Whether you should cut your losses or not. There can be some strategies where you don't have to cut your loss as well. uh, at what place to enter the stock markets, then at what space to add, because if you don't add to your existing allocations, then how will it work out for you? Friends, understand that out of the 15 stocks which you are selecting right now, only 3 to 4 stocks are going to become multi-baggers. Your job is, one, to enter those stocks. Second is to add on to those stocks, because if you don't take it to a higher allocation, then maybe your losers will win, and as a result, your portfolio will not give you too much return. The third thing is to exit. Now, many people believe that you should never exit, right? You should keep riding the stocks for long term. But the main question you have to ask yourself is whether you are actually there for long term. Ask yourselves, Many people I see, friends, they completely lie about who they are. And that is the real problem in investing. Because if you keep lying to yourself, you keep saying, I'm a long term investor, I'm a long term investor, and your actual horizon is for 6 months, 1 year, you can't even see 20-25% downturn in your portfolio, you're really not a long term investor. When people are long term investor, they wait because they understand what will happen 10 years down the line. But to be able to get what will happen 10 years down the line, you should be able to bear the volatility of 40 to 50% in your portfolio. Now, friends, one thing which I've realized during this short journey of coaching thousands of students is that most people are not long term oriented. They are short term oriented. They are medium term oriented. And that's all right. There is no perfect thing in life. You have to keep your strategy in the stock markets very aligned to who you are as a person in terms of your nature. And that's the key. While you may tomorrow decide to increase your investing horizons, but that happens with time because it requires strategy, it requires spiritual alignment. It does not happen overnight, right? It requires a lot of patience. It sometimes also about how much money you have currently for your daily survival. um, do you need that money in some time to come? If yes, the answer is yes, then you pretty well follow a short term strategy. Why am I emphasizing so much on this particular aspect of short term or long term? Because friends, see, many of us have learned investing from Warren Buffett, and we pick the nuggets, the golden nuggets of investing from people like Warren Buffett. Now, the problem is that Warren Buffett is different. He has a very different set of values which maybe common people at this financial positions of their life may not be able to even touch. Another differentiation which I see between the retail public and Warren Buffett is that Warren Buffett runs an insurance company. This insurance company ensures that he has a lot of incoming cash surplus coming in all the time. And so, as a result, he doesn't need to keep huge cash buffers for investing. All he needs to do is that keep investing in the market. As soon as the money comes, more the money, more he can downward average. But the problem with most of the investors in the stock market is that they do not have that sort of surplus money coming in. So imagine if you're already 90% invested of your wealth, then how will you add 20-25% more of your wealth, which you have probably created over 5, 10, 15 years time?